Welcome back to the Rate of Change with York Wealth Management. As advisors to some of the wealthiest families in the country, the Rate of Change is a podcast designed to help you in the pursuit of building long-term wealth through the insights of some of the brightest minds in asset management. I'm your host, Murdoch, and in today's ROCast, I'm speaking with John Forwood, the Chief Investment Officer at Lowell Resources Management. Lowell manages roughly 50 million Aussie under management. It's a listed investment trust which invests in junior, domestic, and global mining companies. They currently allocate roughly 13% to new pre-IPO opportunities, have greater than 10% cash, and the remaining is invested in listed mining companies across uranium, copper, natural gas, oil, nickel, lithium, and a large percentage currently in gold. And they currently run a top-down, bottom-up strategy, so that percentage allocation is constantly changing. As of recording, the Lowell Resources Management Fund has averaged over 10 years 14.2%, over 5 years 27.9% per annum, average over 3 years 8.4%, and 12 months 14.1%. In relation to the S&P ASX Small Resources Accumulation Index, they've consistently outperformed them in that period. And most interestingly, in the past 12 months, whilst Small Resources Accumulation Index has been down 9.8%, they've been up 14.1%. So please, everyone, remember that this is a podcast for entertainment purposes only. Please listen to the disclaimer at the end of the ROCast. If you want to learn more about the fund, please reach out to them directly or speak to your advisor. So with that being said, I hope you enjoy this conversation as much as I did. So sit back, relax, and enjoy it. John Forwood, welcome to the Rate of Change with York Wealth Management.
Murdoch, thanks. Great to be here. Thanks very much for inviting me on.
Whereabouts in the world are you right now?
I'm actually in North America. I'm sitting in a hotel room in Toronto, Canada.
What's over there right now? What are you heading over there for?
Look, I'm doing a bit of a swing through. I've been to Vancouver, which is the home of North American small cap miners. And now I'm in Toronto, which is the home of perhaps larger North American miners. And then I'm heading down to Miami for a Mines and Money conference in Florida in a couple of days. So, and then I'll follow that up with a brief side trip to look at a copper project in South America. So, making a good trip of it.
That sounds like fun. Hopefully, you get a nice hockey game in. Well, look, John, I was just interested where you were, but why don't we start off by telling everyone a little bit about, who is John and how you got into the wild world of financial markets?
Sure. Look, I think I have to blame my father. He's a geologist and had me doing field work with and for him from a pretty young age, and it didn't put me off. So I became a geo, worked around the place, Australia, Africa, Indonesia, for a few years, and then joined a group. I went to the dark side, got into the financing side of things, and joined a group out of South Africa called Rand Merchant Bank, which was a fantastic experience. Was there for more than 15 years in a group called RMB Resources, and we did across the financing spectrum. So we did equity, what we call quasi equity, and project financing and hedging for the junior resources space. So had some fantastic experience there. It was a very successful shop. Finished up there in 2015, and then 2016 joined Lowell Resources Fund, and I've been the CIO there for the past 8 years.
So what exactly does Lowell Resources Fund do?
Look, it's an unusual beast. There's not many institutions, if you like, that do what we do, which is really focus almost solely on the junior resources space. So we're quite broad in a very niche sector, right? We do pretty much any commodity, in terms of metals and mining and oil and gas that you can think of. But we really try and focus on the junior sector where we see the biggest upside potential is.
So when you say you're only focusing on the juniors, does that mean they're only you're trying to get into them seed or pre-IPO, or were you looking to allocate to these companies when they're listed?
Yeah, both.
And
Both
what's the
Murdoch.
percentage? What's the percentage in the portfolio?
Yeah. So we've got a fairly broad mandate in that sense. Most of our portfolio is ASX listed, but we have a number of stocks listed in the Northern Hemisphere particularly the Toronto's TSX Venture Exchange. We've got one or two on the London Stock Exchange, and then we've got a number that are coming through at various stages pre-IPO, so seed investments. And we've got a reasonable exposure to seed investments, even though in general we allocate less cash to them because they are illiquid and much harder to get out ahead of a listing. So at the moment we're around 13 to 14% in seed or pre-IPO investments, some of which, and I think we might discuss this later, are relatively close to a liquidity event. So it's an interesting space at the moment.
Well, that is definitely going to be the fun part of the chat. What are your thoughts on commodities? What stocks you're looking at? Because it's been a wild world of commodities the past 5 years. But before we dig into that, let's just get through the mechanics and how the fund's structured. So when we start there, how is the fund structured, and why did they choose to be listed compared to an unlisted structure?
Yeah, look, the fund's structure has evolved over time. It's got a long history, the Lowell Resources Fund. It's, as I understand, it started way back in the 1980s as a unlisted unit trust for National Mutual, and then when AXA took over the National Mutual organisation, it decided this fund was basically moribund. It, as I understand it, had exposure to the big end of town in terms of mining. At that time, CRA, BHP, Western Mining, likes of those companies were in the portfolio. And at that point, the current management group bought the management company from AXA and really turned it around completely and started to look at the junior sector, where we see the upside is. So from that point to 2003 to 2018, we ran it as an unlisted unit trust. In 2018, we decided to list it, and the real driver for that was the fact that we could then have permanent capital. So as an unlisted trust, you were subject to redemptions and subscriptions. So in a real market downturn, that can really hurt. If you're getting redemptions in a falling market and you're having to sell your portfolio to realize cash in a falling market, that can be very tough. So now that we're listed, the way to trade in and out of the units is on the market. It's listed on the ASX. So if you want to buy a unit, you can just do it through your broker. And I think we're currently trading around $1.30 a unit. The downside of that, of course, is, well, not of course, but most listed investment vehicles trade at a discount to their underlying NAV, and typically we're trading at about a 10% discount to our underlying net asset value.
Glad you covered that, because I was just about to ask that. We've had many fund managers on in liquid or unliquid assets, and one thing which I find quite interesting about your structure is, considering commodity prices whip around so much, it gives the ability to, obviously seek counsel and speak to your advisor, but it gives the ability, if you have a view on the particular commodities, to potentially come in and purchase something at a discount, when people are being fearful, and then, take advantage of when people are being greedy, which is quite which is not exactly normal when looking at the fund managers that deal in the resources space. The majority of them are currently unlisted and then do
Mm,
deal with heavy redemption cycles when the wind isn't necessary and the commodity cycles sail,
mm.
which I definitely find quite interesting.
Yeah, look, I think, well, we think it's a good structure for a volatile sector.
Yeah,
Um, so yeah, we avoid those redemptions, particularly in down points in the cycle, which can be very painful, and not just for investors in the fund, but for the fund's
companies.
investments that see their share price crater as a result. And the flip side of that is that if share prices are getting smashed, then we have, if we've got cash up our sleeve, we have the ability to take advantage of that when the old Warren Buffett be greedy when everyone else is fearful adage. So that's an opportunity that comes around every cycle.
Yeah, I can definitely see why it's happened, and it's an interesting structure to be able to deal with that volatility. So with the fund, what's currently the size of the fund? How much money is currently in the
Yeah, look,
fund?
it's a small fund. It's got roughly $50 million of assets under management. We've grown that from probably less than $20 million since I've been there, um, net of paying out distributions. So that's probably another aspect of the structure that I should mention. There are a lot of LIs listed investment companies out there which do pay dividends, but that's discretionary, obviously, as a company. As a trust, we're a listed investment trust, which is a little bit more unusual. We don't have any discretion. All our taxable profits have to be paid out to our unit holders. So yeah, we've done paid distributions over the last 4 years, and the outlook for this year is that we'll pay a historically relatively high distribution again in 2024.
Had a couple other questions, but let's touch on the performance and the dividends. So, what's the dividend been since you just mentioned the distribution?
Yeah, look, so this past year we pay a distribution in July, August every year. We paid roughly a 7 cent distribution, and this coming year it looks like it could be significantly more than that as a result of some significant profits that we've been able to take in this financial year.
Yes. And the performance of the fund, and obviously it's
Yep.
volatile. So let me phrase it this way: when you have an uplift of free money being pumped in, COVID, that type of thing, how does that perform? Correlated with the markets and the resource space, and then when commodity cycles come off, how correlated is that? Just because the thing is, if we look at, say, the performance as an average over 5 years, it's very, very difficult. It's probably misleading as well, I'd say. So, how would you explain the performance and how it performs with the cycles?
Yeah, look, I think you know because we invest in companies with significant exploration potential, and a real exploration success can happen at any point in the cycle. We aim to, well, we hope to have exposure to that success, with at least one or two companies per annum. Then it means that we're actually fairly uncorrelated to the rest of the market. Obviously, a rising tide will lift all boats, but for example, last year the small resources index fell by nearly 10% on the ASX, and we were up 14%. So strongly uncorrelated to the market, which I think is a really good attribute. Over the last 5 years, we've done 28% per annum, net of inclusive of distributions, but net of fees. And I'd just like to, that's actually the best performance of any listed investment vehicle in Australia over 5 years. And
Sorry, this is the best of all of them across the board.
well, according to Bell Potter and Ord Minnett, universe that they cover, it's strongly outperformed any other listed investment vehicle in their
Well, the only other one
coverage.
which I could think that would be in the echelon or probably beat it would be, say, Hyperion Global, because they've got the Magnificent Seven in the tech space, and that's been
Yep.
volatile. So
Yeah,
that's probably up there as well.
could have been. But look, I just sort of not to brag too much, but it just demonstrates the potential that returns that can be made in the resources space. In many areas, resources is very much the ugly duckling. It's not sexy. Everyone's piling into AI or whatever. But the fact that we've had such strong performance shows that there can be some fantastic returns to be made from this space.
So the other thing which doesn't get talked about a lot, but I want to mind getting into it, is with the fund size. Since you're dealing with a huge amount of small caps, some of these raises, which people aren't familiar with, some of these companies might only be raising $2 million, $4 million. It's not like someone's going asking for $50 million. And then the problem is, as we've seen time and time again, from my background, being a broker on these transactions, is whenever you get a good one, everyone wants it, and then you get no allocation. And then when it's not too certain, you get way too much, right? So
Yeah.
how do you so position sizing is always interesting on the unlisted stuff, but the other question I had is what's the fund sizes capacity before it becomes way too big to manage and you can't get the allocation sizes you want?
Yeah, look, $50 million fund, the average investment size is probably somewhere between, half a million to $1 million. So we do have a reasonable portfolio and spread the risk. And that's, I think that's important that, the average investor in the street might hear about one or two, interesting resources stocks, but they are extremely risky, right? So I think that's what we offer is a portfolio approach to a high risk but high return sector. In terms of allocations, when the market's strong, I think you need to be nimble, and our investment process allows us to be nimble and make sure that we can react quickly to opportunities. And I think most brokers that we deal with through the cycle, recognise that we are there through the cycle. We're there in the good times, but we're also there in the bad times when no one else is answering the phone. So they tend to try and give us our allocation, particularly in companies that we've supported over a number of years, and we do tend to do that. One of our best stocks has been a company called Predictive Discovery, which we backed, all the way from IPO, I think in 2012, and we're still, still one of our significant holdings, and we participate in pretty much every placement through to its major discovery a couple of years ago. So, we try and support our existing portfolio.
So since we're discussing portfolio, I definitely want to get into how the cake is baked. What is the percentage weightings? Let's discuss the commodities first and then the companies. What is the percentage weightings towards specific commodities? And in answering that question, do you find yourself, looking forward and going, lithium's had its run. It might be a while before lithium comes back. So you decrease the allocation in the lithium, or do you just diversify and have it, and then essentially one performs, one's not, and then it's like, how do you manage what's the percentage weightings in the portfolio?
Yeah, look, we have a sort of a top down and a bottom up approach. So we do try and um, uh, manage the portfolio to increase exposure to sectors which we are strongly positive on, and decrease exposure to sectors where we think the going is going to be tough. So, for example, we're 20% into base metals, not including nickel at the moment, and most of that base metal would be copper. And nickel is only 1% of our portfolio, and that's because, not unlike many people, we're positive on copper, and we think that nickel, obviously is having an extremely tough time, and probably will continue to do so for at least the next 6 months, and possibly longer. But nickel is a very interesting space, and we might be able to touch on that a bit further. We're 34% exposed to gold and precious metals at the moment, including PGMs, and that will always be a substantial part of the portfolio, because we are in junior resources, and gold will always be a major feature of junior what junior companies target, because it's relatively easy, or not easy, but the exploration process is well known for gold, and the capital costs are not immense for gold companies. You don't have to build a railway, you don't have to build a port, like you might have to do for coal or iron ore, or something like that. So yeah, it can be within the capacity of a junior company to develop a 100,000 ounce per annum gold operation from scratch. So yeah, so that's 34%. We are pretty cashed up at the moment. We've got about 16% in cash, which is historically high for us. We're not unhappy with that. We see that times are tough, and apart from a couple of sectors, a couple of commodities getting tougher at the moment. So we see opportunities both to support our existing portfolio companies, and to add new positions at relatively deeply discounted valuations. And that's part of the reason why I'm in here in North America at the moment, is to follow up on and find some new North American opportunities. So yeah, and then battery. We did have a very substantial exposure to lithium last year. We've sold down a lot of that position, and battery, primarily lithium, but also graphite. That's 8% of the portfolio at the moment. So that's been reduced substantially. Uranium's another one, perhaps just touch briefly on. We got 4% of the funds by value exposed to uranium. We think there's a lot of upside there through some of those stocks, which we might be able to touch on. We're looking to add to our uranium positions. And finally, oil and gas is something that the fund has always had an exposure to. We've got exposure to both oil and gas in Australia and offshore. I think in a lot of times, it does. We've got about 10 or 11% exposure to oil and gas. A lot of time it does provide a bit of a counterfoil to the gold price. You can see gold and oil moving in opposite directions reasonably often. So yeah, we do like to keep exposure to oil and gas as well.
This is the type of conversation that I could have just a couple of drinks with and be for the next 3 hours. It's like where do we begin?
I think it's closer to beer o'clock for me than it is for you, Murdoch.
9 a.m. in the morning. What's the time there?
We're coming up to 5:20, I think. Yeah.
Oh, well, that's all right then. Where do we begin? All right, okay. Well, let's begin with the uranium story, because the uranium story I found so fascinating. Like, there's a particular people I follow, like a couple of years ago, that said you need to get into uranium because these stockpiles that have been built up on the yellow commodity have been sitting there for years, slowly depleting, and now they've depleted. And please, I don't remember the numbers. I kind of know them offhand, but isn't there something like about 180 or 190 million tons of demand? There's only about 140 or 150 million worth of supply. So they're literally 40 to 50 million of the yellow commodity short. And over the years, and I would love actually to interchange this with the discussion of, people just don't want to stick money into building mines when they don't feel like that commodity is running, and then everyone kind of rushes in at the last moment. as we saw with lithium, and then pushes everything up, and you have an oversupply problem. It's just like this self-fulfilling prophecy that happens every single cycle of the commodity. So,
Yep.
what's happening with uranium? And do you want to give an example with a couple of I don't know, maybe one or two in the Australian, and what's happening offshore and international
Sure.
companies?
Yeah, look, you're right, Murdoch. It is a bit of a broken record, I guess. And you see it. It's frustrating that you see it across commodities, and it's happened again here in uranium, where you know you could see the situation coming from a long time away, and a lot of the uranium bulls like Johnny Borshoff or whatever, did start to sound like a broken record post Fukushima. There's not enough new supply. There's growing demand. There's no alternative. The alternative, source of supply, like the reprocessed highly enriched uranium that might have come out of the former Soviet Union, back in the 90s and 2000s, is not there anymore. But at the same time, the the power utilities who have got nuclear energy reactors weren't supporting new supply to any great degree. And so the problem has just built up and built up, and finally, we've had push came to shove last year, and the uranium price jumped over 100%. Back, and now it's over $100, $100 a pound. So yeah, look, you're right. There's a massive shortfall, massive deficit, supply deficit at the moment. And you've got the two big guys, the two elephants in the room, which is Cameco out of Canada, which is the second biggest producer in the world. And then you've got Kazatomprom out of Kazakhstan, which is the OPEC of, in fact, it's double OPEC, or triple OPEC. It's more than 30% of world supply. So OPEC came out in January and earlier this month and said, look, those expanded production targets that we talked about last year, we ain't gonna get there. They've got problems with supply of reagents, and I think they've got other problems in terms of wellfield ISR performance. So they're going to be well short of what they said they would be able to do in terms of ramping up their production. Cameco, have actually said, look, we think we're still going to hit our targets, which was a surprise to everybody. But they're actually buying in the spot market. So, second biggest producer in the world is actually buying uranium rather than, selling, having enough production to meet its. All the uranium at the moment is, as I understand it, is spoken for, and new supply is not available just at the flick of a switch. It's a very long, very tortuous process to bring a new uranium mine online. So that supply deficit, and we're talking about 50 new reactors in China over the next, I think it might be decade or so, which is a massive amount of new reactors. And then you're seeing pronouncements out of COP26 that countries like France and the US want to triple their nuclear energy production through to 2050. The forces there are sort of almost inexorable that the price is going to grind higher, and it's a relatively small market in commodity terms. So that leads to potential volatility. And we saw a significant jump from $80 a pound to over $100 a pound late last year. And the pundits are saying, well, we could easily see it go from 100, 120 in a matter of weeks, and then there's blue sky beyond that.
Yeah. Everything you're saying is so interesting. Like, what was it, 13% cut to the world's largest uranium producer? Just nuts. And then I heard another fund manager say that when they were studying commodities, that commodities, when you get a wind behind them, have a tendency to, from the absolute bottom to the peak top, like lithium, go up 10x. So I'm just looking at a chart from uranium, which was peak bottom in, 2016. I think that was about $20.
About
So
18,
now
I
it's
think.
at,
Yeah, sub 20.
yeah, about 18. So now it's at 103. So, a bit, depending where you take that from. So, say the average peak bottom's been roughly $25. Now it's, up 4x from the bottom. Yeah, it's quite interesting.
Mm.
And the
Yeah,
other thing
look
which
at
is quite interesting on the uranium story as well is with the war with Russia and Ukraine. You've seen it, probably one of the main reasons why lithium and car batteries are kicked off is the European Union and NATO are trying to wean everyone off Russian gas. And as a byproduct of that, well, that's the gas side to get batteries, but you can't just go straight to everyone's an electricity by 2050. You need gas for various things. So the best solution is essentially a nuclear plants, and the technology is improved. So I can't remember the numbers, but how many? Is it France and the UK as well that are bringing nuclear reactors online to kind of solve that problem? I was
the
reading
UK
somewhere.
definitely have got a new 1 gigawatt reactor on the drawing board. I'm not quite sure exactly what stage that is at, but yeah, look, there's many countries who are talking about adding nuclear capacity to their power fleet, their
How long
electricity
does it
fleet.
take to build a reactor? Like, say
Ah,
that one in the UK. I genuinely don't know, right? Because everyone goes,
yeah.
you hear the headlines, okay, we're building one. Okay, that's great that you're building one, but how long does that actually take
Oh,
from
look,
they announcing it to coming
if you
online
look at
and
the last
purchasing it?
reactor that got built in the US, it took a lot, uh, I think something like 10 years from permitting, and there were some massive cost overruns. So that is the downside to this. That in the Western world, permitting is very, very difficult, and with cost escalation that we've seen in projects of any sort recently, and these are massive projects. So yeah, you've got to be very wary of cost overruns. That may or may not apply so much in China, and China is definitely the country which is building out its reactor fleet faster than anybody else. So I think my expectation is that we'll see much more reactor capacity put in place in China than anywhere else over the next 10 years.
Yeah, so interesting. So if everyone wants to go, clean by 2050, which I don't think is probably going to happen, more of a pipe dream. The gas is what, as everyone says, the transition point. But even gas shortages, right? You know what? Origin Energy, front sold all our forward contracts, what, $9, whatever the contract was, and offshore. So we're kind of running out supply even on the east coast. So you're seeing places like the Beetaloo Basin being built up, right?
Mm.
But the problem is you get greenies and everyone's saying we don't like it. Fracking's bad. But so I'd love to hear your thoughts of what's happening in the gas market, and I suppose maybe one thing also to cover as well. The Australian gas exploration is completely different to the American, say, with the Marcellus Basin. But people hearing, oh, it's the same. But people don't understand that the ownership of the land is different in America than it is in Australia. So I'd love to hear your thoughts on what's happening in that volatile space. And for listeners out there, the gas price has kind of gone from like $2 to $9, then back down again. So it's another incredibly volatile commodity with potentially a shortage
Yeah,
problem.
it's
So I'd love
and
to hear your thoughts.
it's very regional, right? So the gas price in WA, which is a market unconnected to the east coast, is quite different to the gas price and gas market on the east coast of Australia. And then the gas market in the US is quite different again, and the drivers are quite different. You're seeing the US become in a pretty short space of time the largest LNG exporter in the world. And then Joe Biden has now sort of put a pause on any new permits for gas export plants in the US. In Australia on the East Coast, definite, massive squeeze. And one of the big drivers as that has been, the Bass Strait gas production absolutely falling off a cliff. It used to be one of the mainstays of East Coast gas. And, in the next few years, it's just depleting at an extremely rapid rate. So, the gas price in, Eastern Australia, you're hearing $12, $14, even sometimes more than that, a gigajoule of contracts being written recently. And in WA, they've got the gas reservation policy for onshore gas, which is a real hot political potato. But as you said, they've gone from $2 to $9 in a relatively short space of time. They used to, Mark McGowan used to sit there like a Cheshire cat and say, "Oh, look, our system's fantastic and it's protected, local consumers." And then, it all came back and bit him. I get Betty regrets saying that. So, look, you're just on your point. The ownership of minerals, in the US is quite different to Australia in general. Australian minerals are owned by the Crown in the form of the individual states. In the US in general, the minerals and gas is owned by individual private ownership, which may or may not be the same as the owner of the surface rights. So, look, each system has its challenges. There's possibly greater resistance to new gas projects in parts of Australia than there are in parts of the US. But you can have very, very disparate ownership of minerals in the US and have to chase down dozens of people who've got small percentage ownerships in various gas fields to tie up the rights. Whereas in Australia, in general, there's only one owner, and that's the state. So, look, and the other big difference, I think, is the infrastructure. Infrastructure, US has got gas pipelines running all over the place, whereas Australia, there's a number of projects which would be online already if they had better access to pipelines. So putting in new pipelines is really critical to developing new gas, particularly on the East Coast.
Yeah, the infrastructure spend on some of these projects is so extensive. I often kind of wonder whether or not, Australians building out these large gas projects, we'd be better off just using, bonds, like 300, $500 million bonds, and just get it done, and continuously going back to the market and devaluing the shareholders' value with raise after raise, coming into F. GF raises and dilution and completely destroying the value of people before, but people with massively deep pockets out of the States, just sit back and relax and just keep taking the stock. What's with gas? Do you have much offshore? Or is it in Australia? And are you owning producers, or you're in the exploration side?
Look, we've got a bit of both. You'll see in our portfolio recently we've got back into Karoon is a Karoon Energy is an oil producer mainly, but we do have offshore. We've got interesting CBM play in Mongolia called TMK, which has got what we think are some of the best coals in the world for gas production. And they're on the, not far from the Chinese border. So there is potentially a ready market for their gas. Here in Australia, we've got exposure to things like Comet Ridge in Queensland with their Mahalo project, which is in joint venture with Santos, and their Mahalo North project, which they own 100%. So that, has a relatively quick time frame to production if they choose to take it. I think it's about 17k tie in to the nearest pipeline. But for a bigger development, they're going to need to put in a much larger diameter and longer pipeline to connect to down south to the major East Coast network. What else? 3D Energy is one that's exploring offshore Victoria in joint venture with Conoco. That's a pure exploration play, but some relatively high chances of success on some fairly substantial targets, which hopefully will be drilled in 2025. So look, we have a mix of exposure to oil and gas, and that's just a couple of examples of our investments.
That's quite interesting. I noticed you didn't mention the Beetaloo Basin, and you probably know the history of that a little bit more than I do, but to my understanding, the four largest gas deposits in the entire world are Russia, Saudi Arabia, Marcellus Basin, and what I think the Texas guys came over in the '70s and identified the Beetaloo Basin, but everyone was like, no, no, it's too dry. There's no gas there. But recently, it's been incredibly expensive. It's been a political nightmare with the greenies and
Mm,
all that type of business. So I can understand why investors have shied away from chaos, but I'm just curious in your thoughts with what's happened to Beetaloo, because it was last year the government gave them one of the companies up there a $1.5 billion grant to essentially build out a port right next to the Japanese giant up there as well. I can't
mm.
remember the name of
Is
it.
it Intex?
Impacts, yeah, yeah.
Yeah.
And then as you were discussing with the infrastructure spend, like people don't understand the cost and the amount of money associated required to get this gas piped, into the Northern Territory, then down to Queensland.
Mm.
So I'd love to. So two questions there. Love to hear your thoughts on the Beetaloo, and then secondly, why aren't you in the Beetaloo, or is it more of a situation how you like the Beetaloo, but you just don't think due to the cost of something that the timing's right? I'm very interested to hear your
Mm.
thoughts on the Beetaloo Basin.
Yeah, look, Murdoch, I think perhaps the short answer is we think that the Beetaloo is for the big boys, and we're focused on the juniors, and as you touched on, the reasons for that are the costs are very high. The drilling costs are extremely high, and then the infrastructure costs are also extremely high. And generally, we want to invest in things which can be within the reach of a junior company that might only have a market cap of less than 200 million. So it's just what we
Oh,
do.
so
Having
that's what
said,
it is. Because that's what I was asking. Because Tamboran, as an example, pre-raise had 250 million market cap. So you're saying
mm,
$200 million is the
yeah, look,
the
it's not hard and fast, obviously, and hopefully, all our investment companies will blast through the 200 million market cap valuation, and go into a couple of billion, and we may or may not hang on to that point, but yeah, we're generally looking, in the what you might call the micro cap space. But the Beetaloo, look, there's no doubt is fantastically endowed with gas. It's just, as I touched on earlier, the US has got fantastic infrastructure in place, and the Beetaloo, is generally devoid of it.
Yeah, so I hear what you're saying, as in it's a great opportunity. It's going to take a long time. So the point you're making is if you go find something, then there's no infrastructure around, then you have to go get the money to build that. And it just becomes
Mm,
such a long. And the question is, do you want to play that game? No, that makes a
yep.
lot of sense. Okay, well, since you mentioned, gas and oil, what are your thoughts on what's happening in the oil?
Yeah, look, it's a pretty interesting one, and as I touched on, it's an interesting sort of counterfoil, or um, in some cases can be decorrelated to the rest of the commodities market. So, for example, oil prices obviously has a big feed into inflation and inflationary costs. So if you see the oil price jumping, then you may see inflation jumping, and then you may see, or you're likely to see interest rates rising, and you're likely to see, in that case, pressure on non-yielding stocks, like such as the speculative sector that we're in. And you're also likely to see pressure on things like the gold price. So that's why we like to have, or I like to have, exposure to both gold and oil, for that reason. So we're seeing, China is now, I think, the biggest consumer of oil. 13, 14 million barrels a day out of a total of around 100. We're seeing US production rose, or didn't, rose last year, despite the rig count actually being flat to down. So there's been a lot of efficiencies extracted in the Permian in the US, and the US is, I think, um, one, if not the one of, but the biggest producer in the world now, um, uh, which almost matches the Chinese consumption, just sort of coincidentally. So you've seen, I think the Chinese economy, and this is my perception based on the iron ore price and the record imports of iron ore, the copper TCRCs and the record imports of copper, the record amount of electricity consumed in China last year. I think the Chinese economy is actually going pretty well, and added to that the record imports of oil. So I think you may see, and OPEC are actually forecasting this, that you could see growth in oil demand this year. Russia is, as a major producer, is not forecasting it will add any production this year, may come off slightly. So you may see the oil price, and we've seen it rise. I think it was, WTI was $79 on Friday or thereabouts a barrel. You've seen it rise. If OPEC, continue to have production discipline, and in particular the Saudis, then you could see the oil price, continue to strengthen. And yeah, obviously that would be good for oil producers. And just as a side comment, the oil market, or the development of new oil fields and capital spend on the oil business has really been a laggard in the last decade. We're seeing big boys like BHP and Shell start to reinvest, but they did have a number of years there where they were saying, we're going to spend our capex on solar farms rather than our own core business. But we've seen that start to change over the last 18 months or so. So yeah, but that's can take a while to flow through. So I think as we stand today, we may see more upside than downside to the oil price.
Yeah, that's very interesting. And last one I just wanted to get into is what's happening with Dr. Copper.
Yeah.
And then I would love to discuss, how the IPO market's kind of slowed down, and when do you
Yep.
think it's going to be back again? But first of all, what's happening with Dr. Copper?
Yeah, look, Dr. Copper, it's been a bit of a head scratcher. It's really been range bound between sort of US $3.50 and $3.80 a pound for what feels like quite a long time, most of 2023, and we're still stuck there today. Whereas, all forecasts are saying, there's a copper squeeze coming, and it could come. A lot of forecasts have said, it's going to be 2025, but it could actually be accelerated. We could see that this year. So why hasn't the price jumped, out of its range-bound trading? Look, there must be, it's a substantial market, 25 million tons of copper a year. There must be some stockpiles that are off warehouse that we can't see, that are being consumed. But warehouse stocks are generally pretty low. So look, the fundamentals are very, very good for copper. I'm not telling people anything that they don't know. It's really interesting. I saw an analysis last week of two of the largest new sources of copper production out of South America, Quellaveco and QB2. Both of those, if you're looking for as an investor, by the companies that have built them, if you're looking for, say, a 15% IRR, return, both of those are underwater. One needs $4.50 a pound, and one needs $6 a pound to hit that 15% IRR. So, at current levels, there's the incentivization for new copper production is really lacking. And I say this all the time. Every project that gets delayed or deferred adds to the future deficit. So yeah, it's something that we, along with many, we like the sector.
So any project, that comment there is fascinating. Any project that gets delayed or postponed, adds to the problem with supply.
Mm.
So we're seeing this everywhere, where pre-COVID and then run up, money was pouring in. Everyone's finding new projects, doing raises. Everyone feels rich. But now, speaking to clients, investors, institutions, family offices, everyone's kind of feeling poor to an extent. So where that may have risked capital before, They're finding safer houses in, I don't know, high-end property lending or property developments or something equivalent that could tick along. And then the other thing which I'm finding very crazy is across the board in most asset classes, some of my colleagues have said that the deals they're seeing right now are the best that they've seen from a valuation standpoint. And I heard a fund manager say the other day that last year, or the IPOs from last year, so the year before, have all come off like on average, like 48%, was it 58%, something quite large. So valuations is very, very interesting. Bit of a statement there, but I suppose my question on the back of that is, what is happening in IPO land? I read an article you wrote that said, what was it? Last year saw little to no IPO action, with only 3 junior minor companies listing on the ASX in the past month or two. One was gold, one was rare earths, and one was lithium Kali metals.
Yep.
So my question after all that as well is, what do you think is going to get the IPO market going again?
Look, it's probably Jerome Powell.
You reckon?
That's a flippant comment, but interest rates are a major factor in support for speculative investment. If you can stick your money in the bank and make 5% versus as you mentioned, IPOs, which you're actually going to lose money on from the 2022, a lot of the 2022 IPOs. Why wouldn't you put your money in the bank and earn a very safe 5% or something like that? So, if and when interest rates come down, particularly in the US, then you will see, in my view, you will see increasing support for the more speculative investments, and in particular, as an example, the junior resources exploration sector. So, yeah, look, hopefully that's right. That second half of 2024 is going to see moderating. The first half of 2024 will see continued moderation in inflation, and then second half of 2024 we'll see interest rates start to fall. And so in that case, we could see a much stronger IPO market on the ASX in H2 2024. Fingers crossed.
So if any IPOs are coming out, with what we discussed with the commodities, I suppose, what is your outlook on, if a deal came out, what's the commodity to be in?
Yeah, look, I think we've touched on a few of them. Uranium looks good, particularly on the more exploration side of things. I think a number of the advanced developer uranium companies perhaps ran ahead of themselves a bit in 2022, and 2023 was more a consolidating year. Copper obviously is something that everyone is interested in, and we're definitely seeing a bit of a groundswell both in North America and Australia of interest in copper. Gold will always be there, and I think that also would benefit from falling interest rates. Other sort of more esoteric ones, I think PGMs look pretty interesting in 2024. There's the prices have fallen a lot. The big producers in South Africa and Norilsk in Russia, particularly for palladium, supply is falling. There's a deficit there, and as if EVs or if hybrids and plug-in hybrids are preferenced over pure EVs, then that needs auto catalysts, and PGMs are that's a major consumer of PGMs. So platinum, palladium look pretty interesting. And we touched on nickel earlier. I think there's probably no rush, but the major use of nickel still is not batteries; it's stainless steel. And Chinese production of stainless steel was a record last year, and I think it's going to be strong again this year based on how we're seeing the iron ore price. So while there's still a surplus of supply coming out of Indonesia through the new technology and nickel laterites, I think there's a chance that in the second half of 2024, for what is historically the most volatile of metals, we could see nickel start to rebound. So that's an interesting one to watch.
Yeah, that's very interesting. I suppose I was just thinking to myself then, from what you said before, all these plays in Australia and the resources sound fantastic. You find a site, but again, the problem comes down to the ability to finance them. So I spent a bit of time in the past couple of years speaking with German bankers regarding corporate bonds. So I'm just wondering, there's a thing happening over in the Saudi and Europe where they're using essentially bonds where you can forecast the life of a mine in 30 to 50 years, and they're essentially reverse engineering it, right? So they know exactly the money required to get it out, what's essentially there, and then they just get the job done instead of having A, B, C, D, E, F, G on the on all the raises, coming through, which,
Yeah.
anyone listening that's doing the brokering probably is going to shoot me for this. But from your position, who's been doing this for a long time and seeing it, I'm just very curious to hear your thoughts on the relationship of, say, corporate bonds in resource companies, because I've had conversations with people over the years in Australia. Either they're not familiar with it or they're familiar with it, and they've really seen one work in Australia. But I keep seeing all these large, capitally intensive projects that look
Mm.
fantastic where shareholders go into it. It sounds exciting, 2, 3 years, and then it falls over because, I don't know, rivers run dry. So do you think a debt option via a bond, a corporate bond, is appealing for Australian miners here? Or do you think, I don't know, what's your opinion?
Yeah,
Is it
look,
balanced?
uh, for some, look, that's what Twiggy Forrest did with FMG. Access the, if you like, the junk bond market out of the US to finance Fortescue into its first production. And it was a nail biting thing with when the iron ore price fell. But that's he has become the third force in iron ore, and hats off to him. So for substantial projects, as you mentioned, with 30, 50-year mine lives, I think it can work. You've got to get the interest rate right, obviously.
Apologies, I should say as well, these bonds begin at either euro or US dollar at $500 million, because the cost of building one for 50
Yep,
million US is the same as 500 million. So the projects aren't small,
yep,
or the life
indeed.
cycle is
So
not small.
yeah, I guess the issue is, a lot of mining projects, they start out with relatively short lives of maybe 5 to 10 years, but a lot of them do keep going for decades. They find more and more reserves, keep on exploring. So that's not ideal for putting in place a long-term bond, unfortunately. And you're right. Look, development capital is very, very hard to find at the moment. In fact, there's a number of developers that I can mention that are sitting on. They've got a feasibility study tied up with a bow. They've got their permitting all done. They can't get and they might have a strongly positive NPV. They can't get the development finance, because providers of that capital have seen massive cost overruns and schedule blowouts in many projects over the last few years due to cost escalation, and also due to a shortage of labour, that's linked, a shortage of labour in the industry. So as come back to that point before, every project that gets delayed or deferred is feeding into the future deficits, and we're seeing a lot of that at the moment.
Well, you're definitely going to be seeing a lot in your trip from the top to bottom, with hopefully a stop in Miami. And, hopefully you're trying to find the high end cigars running around that beautiful city.
Yes, I've got that on my list. If I've got a bit of spare time, I've got some cigars to buy from a friend of mine who's a cigar aficionado back in Melbourne. So hopefully we'll be sharing a Monte Cristo together when I get home.
Fantastic. Last question I'd like to finish on is, what keeps you up at night, and what gets you out of bed in the morning?
Look, I think the thing that keeps me up at night is the, if you like, the bets we've placed on what look like really good exploration prospects, but as a very good geologist, I know Chris Cairns likes to say, Mother Nature's a bitch, and she's had a lot of time to move the furniture around downstairs. So even the best drilling targets can come up dry. So that's something that keeps me awake at night. And what gets me up in the morning, I think it's probably the same thing. The excitement of the potential for one of our portfolio companies to make a big discovery.
Well, the only constant in life is change. So, with that
Yeah.
being said, so if anyone out there wants to learn more or change up what they're doing, what's the best way they can reach out to you to, I don't know, broaden their
Uh,
minds or learn more?
Sure. Look, if people are interested, please contact us via our website. Get on the mailing list for the monthly report. That covers our individual portfolio, but also tries to address what's happening in commodities markets. So yeah, hopefully people have a
What's
read
your
of that.
website?
It's lrfm.com.au. Yeah. Lowell Resources Funds Management, LRFM.
Fantastic. All right, John. Well, it's a pleasure having you on, and time for either a drink or to head to bed in your side of things. And my day's just getting started. I think the market's opening in 2 minutes, so we'll see what the ASX has in store for us today.
All right, fingers crossed. Thanks a lot, Murdoch. Good fun. Enjoyed it.
All right, have a good one. See you, John.
You too. Cheers.
Any views expressed in this recording do not represent the view of any other third party and are the sole personal opinions of the speaker. Any reference to financial product does not constitute advice or recommendation, and before any action, you should seek proper advice from your financial professional. Australian listeners should head to www.moneysmart.gov.au to find more information on obtaining financial advice. To get in touch with York, head to our website www.yorkwealth.com.au.